How do you know what you're supposed to pay in your student loans? The good news is we're going to give you a couple of rules of thumb that are going to make it way easier so that you never get a bill in the mail and you're like, oh my gosh, where did this come from? How do I owe this? This is going to be real helpful too, because when you're in school, a lot of times you don't really understand what you're actually going to have to pay when you exit, right? So if you do want to be debt-free, if that's the goal, which a lot of people, that should be your goal, or even if you're pursuing forgiveness and you know you won't be paying back your debt in full, we're going to show you some great rules of thumb to use so you can know what you're paying versus having to guess. So let's get started. So the first thing I'd like to tell you is the 1% rule. The 1% rule is basically what you're going to be defaulted into if you don't select any other repayment plan. And basically most lenders use this. They're going to ask you to pay your loan back in 10 years. Most people think that a student loan shouldn't be like a home mortgage. You shouldn't keep it for 30 years, and I really can't disagree. So if you're going to have your loans be paid back in 10 years, that's the plan that your lender is going to ask you to sign up for. You're going to have to pay about 1% of what you owe every month. So if you graduate with $50,000 of student loans, your payment would be 1% of $50,000 every month. So that's about $500 per month. And that's the standard 10-year plan. That's the default payment method that's selected for any federal student loan borrower who does not give any income information or select another repayment plan. Now, if you look at private lenders, most private lenders will set you up for maybe a 10-year repayment plan as well. That's the most common thing that I see. Now, if you're doing a refinancing, you actually get to choose your repayment plan. So you might choose a 20-year or a 10-year or a 5-year or something in between. Now, that's just an idea to figure out what your standard 10-year plan might be, but what if you were paying back your loans based on your income? Here's another rule of thumb. I call it the 8% rule. So a great way to think about what you're going to have to pay is figure out what your taxable income was last year. So pull out those tax forms, y'all, and then take 8% of that, and then that's what you'd have to pay annually for your pay-as-you-earn or revised pay-as-you-earn payments if you're single. So, for example, if you made $100,000 last year, good for you, but $100,000 last year times 8%, so that's $8,000. So divide that by 12, and that tells you that you're going to be paying, something in the neighborhood of like $650 to $700, right? Just quick back of the napkin math. And here's a little fun tidbit. If you're going to be on a different repayment program, your payment might be higher. For example, income-based repayment, or IBR, is this older repayment program that some people are still on, and you'll have to pay, technically it's 15% of your discretionary income, okay? And that's French for you get a deduction, and then we calculate a bunch of things kind of magically behind the scenes, and then we come out with the final number. And so here's a great rule of thumb. I call this the 12% rule. So the 12% rule says that your payments for your IBR are basically going to be around 1% of your taxable income from the prior year. So for example, if you made $100,000, your annual IBR payments would be about $12,000, and your monthly payments, divide that by 12, would be about $1,000 a month. So a lot of times when somebody tells me they're an income-driven repayment or income-based repayment, I can know very quickly what repayment program they're enrolled in based off of when I find out what their taxable income was. Is the payment 1% of that taxable income each month? If it is, they're on the IBR plan because of the 12% rule. And if they're, at something significantly less than that, then that's the, 8% rule where you're on pay-as-you-earn or revised pay-as-you-earn. And that's if you're single. If you want to figure out what your student loan payment would be if you're married, it's the exact same thing if you're filing taxes jointly. But instead of taking just your income, you have to take your household taxable income. So you look back at your combined taxable income for both you and your spouse together, and then you take 8% of that for pay-as-you-earn or revised pay-as-you-earn, or 12% for income-based repayment. And why is it 8 and 12? Because you might have heard that it's 10% for pay-as-you-earn and revised pay-as-you-earn, and 15% for income-based repayment. The reason for that is because you get a deduction based off of the size of your family before you have to pay any percentage at all. So for most people, that's 150% of the poverty line. So that might be $18,000 for a single person, maybe 20, 30 something thousand for a larger family. So if you just run the math, it kind of works out where if you just pretend there's no deductions at all, it ends up being about 8% or 12% of your taxable income. Now, what if you're on a different plan? What if you have, an extended plan or a graduated plan? How do you calculate that payment? So what I tell people is if you're on anything but a refinancing plan or one of these income-driven repayment programs like revised pay-as-you-earn, income-based repayment, then you're not paying your loans back the right way, pretty much guaranteed. Because if you want to pay something but you don't want to be paying, the 10-year plan, then you should be getting interest subsidies on something like revised pay-as-you-earn. Or if you can afford, that 20-year type of payment, then you want to refinance if you're going to eventually try to pay the loan off to get a lower interest rate. So that's really the truth, is you don't really need to know what your payment is, except for, is it an income-driven plan or is it something where you're doing a private refinancing? And, in terms of figuring out what that private refinancing payment is, a 20-year payment would be around 0.6% of your total principal amount each month. So if you owe, $100,000 on your student loans, the 10-year plan, remember the 1% rule, was $1,000 a month. And then if you have a 20-year plan, 0.6% of $100,000 is $600 a month. That's your 20-year plan monthly payment, about $600 a month. And then if you're trying to do a 5-year plan, your monthly payment is about 2% per month. And then if you're trying to pay your loans off in 2 years, which is, a Herculean task, you'd have to pay about 4% of your balance every single month. So there's all these great rules of thumb. And, I think that it's just really important to have a clear understanding as to what your payment is and why, because most people, from my experience, have a very inefficient payment that they haven't really thought a lot about. So the last little bit of advice that I'll give you is you can also have federal student loans and private student loans. I see this all the time, and that can actually cause two payments. It can cause one that might be based on your income to the federal government, and one that might be to a private lender that might be, based off of a standard 10-year plan or something like that. So you really got to understand what the payment is and why. So just remember that 1% rule for paying your loans back if you're doing a 10-year plan, or the 8% and 12% rule of your taxable income if you're paying your loans back based on your income under an income-driven repayment plan, or if you want to pay for 20 years, 0.6% instead of 1% of your loan amount, and then if you want to pay it back in 5 years, 2% of the loan amount. If you want to pay it back in 2 years, 4% of the loan amount. Those are all back-of-the-napkin numbers. You can certainly type in a payment calculator and just, we have them on studentloanplanner.com. You could take a look and see what your payment would be. But if you have a question about what your student loan payment is, leave it in the comments below. Share it with us. We'll try to give you some feedback as to whether or not we think that's a good payment, and just try to give as much detail as possible. And we'll maybe be able to show you if you could get a better payment doing something else. Thanks for watching. Travis from Student Loan Planner.